If you take a look at the 10-year average return, that is the annual return over the last 10 years for these three ETFs. I'm not really going to go too much into detail about SCHD. That is the Schwab US High Dividend stock.
It's also weighted for the S&P 500. It
Yeah,
just pays you more in dividends. So it has a lower growth rate, but it takes into account it pays you also
yeah. I
dividends.
think the regular growth rate is like 7, don't quote me on this, like 6, 7% a year, maybe 8, and the rest is pretty much dividends. So this annual return includes dividends, a dividend return, which I think currently is like 3.5% or something like that. Um, but that's just high dividend paying companies, Coca-Cola, Walmart, stuff like that. If you're into that type of stuff, that's another option that you can invest in. But right now, I'm just going to take a look at QQQ and VOO. And for those who don't know, QQQ is the Invesco Nasdaq ETF. I think it's the top 50 or top 100. It's a Nasdaq composite. So all these tech and growth stocks, which have been dominating the market, which is Microsoft, Tesla, Amazon,
Google and
Apple,
Nvidia.
Nvidia. That's all QQQ Nasdaq style stocks. VOO is the Vanguard S&P 500 ETF, and I'm sure you guys know, but in case you don't, the S&P 500 is the top 500 companies in the United States, and companies get added and dropped from that list all the time. So, but anyways, VOO is a Vanguard run portfolio, passively managed, of the top companies within the S&P 500, and 50% of their holdings is pretty much most of what you see in QQQ. But I like VOO just as a overall broad-based U.S. economy investment. Like if the economy is doing well, VOO will rise. QQQ is more speculative. I invest equally between the both. So in this spreadsheet I made, actually will kind of explain what your money will do if you invest in just QQQ and VOO alone.
I want to interject real quick.
Yep.
So, one thing I do recommend for this, actually, not for this, especially for people, and why this is actually, for the long run, safer than what I do, is because this adjusts to the market, right? So, you have had great companies like, I don't know who made BlackBerry, right, or Nokia, but guess what happens? They stop innovating, and
Right.
then they don't do well,
Right. Right.
right? So, unless, if you keep, invest in particular companies, sometimes you have a company that does really good for like a couple of years or maybe a decade. All it takes them to stop innovating, and then you lose out. And what this does, it protects you from that. Because
It
yep.
diversifies passively.
So what I do, I look at finance and stuff like that, but that's more risk to it because I have to look at more stuff. I try to limit it. This has a good growth rate. I'm gonna be honest, right? So you're not managing it yourself. You're getting a good 16%, right? You're beating what the bank that may offer you 1-2%. Congratulations, you may be getting the inflation level, and that's it. So you're breaking even. This, you're making money.
Yep.
You're making a lot of money. I mean, if we scroll down, I mean, if you want to scroll down, you can show
Yeah.
people.
Well, I'll get there. Let me just
Yeah.
explain it to them so they understand what's going on. So, if you look on the chart on the left side underneath the 10-year average return, underneath the total where you see QQQ and VOO, that is a 16.97% rate of return. If you would invest equally amount of money between VOO and QQQ, you should get around a 16.97% rate of return. Um, so if we go a little bit to the
A
right,
year, by the way, that's what it means.
yeah, annually. So if you go a little bit to the right where it says 100K investment on that first chart starting from year 0 going on and on, that's the rate of return you will get off of just a $100,000 investment, and of course there's market dynamics at play. This is just an average. I mean, you can buy at the top of market and then the next year is a bear market, whatever. But over the long 10 years, this is the rate of return that you should get. So starting from $100,000, you see at the end of the first year you'll be at 116.9, and then that compounds over time. So, Alex, actually, can I see the mouse and the keyboard actually, so I can? Yeah, I'll do that. So if we start at $100,000, right up here, 100,000, and you look at the formula, which I'll click, you can see. So that's $100,000 times 1 plus the rate of return, and that's what you get for the next year, so on and so forth, and you'll see.
So you're not. So this is assuming you don't even invest a single dollar more extra.
Yes, this is just $100,000 investment based off of that 16.97 percent rate of return. So after 10 years, you'll
More than quadruple it.
yeah, almost 5x your money,
Mm-hmm.
right? And then look, after 20 years,
You're a multimillionaire.
exactly, you're a multimillionaire. So if you win a lawsuit, you get 100,000. Hey, I'm not telling you to do it, but if you have cash sitting around, you don't know what to do with it.
All we're gonna say
This
is
could be
what
an
we
option.
would do.
This is what we would do. Right. And so that's pretty much self-explanatory. That 100,000 after 10 years will be $479,000 after 20 years, and it just gets exponentially more and more and more. After 40 years,
52
you're
million.
52 million. Now,
So you start at 20, and by the time you're 60, you have $52 million. That'd be pretty good.
exactly. So this could be a retirement thing for you.
But we also know not everyone has 100K to just throw in the stock market. So the one on the right is a little bit more realistic, right,
Yes.
for more people.
So let's just say you're able to commit $1,000 per month, and which might be a lot for some people, but after a while you get a stable career, like $1,000 per month is doable. So we'll start off, and we put 12,000 because it's easier for calculation value. 1,000 per month, 12K per year. So your first 12K, again, and then we look at the formula. Every year you're gonna add additional 12K because you're investing $1,000 per month. So starting from your first year, you invest $12,000 that year, and then look, and after 10 years, you're at
I wish we
325,000.
had a line graph. It'd be better
Yeah.
visually because people don't understand. They look at the first couple of years and they realize they think it's so slow. Think about it like a snowball, right? It starts off slow, like it's small, but then after a while it keeps rolling, it gets like a
Exactly.
freaking huge.
Exactly, and that's what we're
Right.
going to look at right here. So look, after 10 years, you're at $325,000 if you just invest $1,000 per month.
That's pretty close to the $100,000
Yep.
initial investment. Like
Now
month.
let's look after 20 years. So after 20 years from $1,000 per month, you're at almost $2 million. So, and let's just say you work for 30 years and you plan to retire, you're at 9 million. And then look, after 40 years, 43,000. And that's just off
43
of
million.
43 million. I'm sorry, guys. That's just $1,000 per month, right?
Yeah.
And if we want to play around with values a little bit, let's just say you can commit 20. What the strategy that I can do is usually I can invest about 24,000 per year.
So 2,000 a month.
yeah,
And
2,000
you have
per
to
month.
change it in the calculations.
Yep,
Yeah.
I will. So let's just say you can invest
Literally double.
double, so 2,000 per month, right? I'm gonna have to click and drag.
Oh, you did 2,400.
Did I do 2,400?
Yeah, you got it.
you did.
Oh, my bad. Let me just back that up real quick. All right. Here we go. So let me just click and drag this down. Boom. So if you can invest 2,000 per month, look at the difference now.
Now you surpassed the $100,000 initial investment.
Yep.
Wow.
And you surpassed it.
That's crazy. Yeah.
See
And
where you
then-
were at in 40
And look
years.
at 20, look at 30 years, 18 million. So you can retire.
At 40 years, you'll be almost worth $100 million.
Exactly.
That's generational wealth, dude. That sets you up so far. And that's just in the stock market, right?
That's just the 2 ETFs.
Yeah, that's not including your home. That's not including anything else.
Exactly.
Right.
And you might have other assets.
We have a
too.
401k as well. That's
Yeah.
separate.
But look, and that is just the easiest strategy, and this is why I'm big on it. QQQ and VOO. For those, who are new to investing, make that your bread and butter. That's what I would do. You can do whatever you want. I'm going to make that clear. Disclaimer, this is not financial advice. This is merely opinion from people who have experience in the market.
And something real quick. Let's just assume once you decide you want to retire or whatever, after taxes, because it's capital gains, right? You have 10 million, which is obviously you're gonna have a lot more.
Yeah.
But let's assume just 10 million, right?
Right. So at the end of this, when you want to take the money out, you have to pay.
It's like
what-
at most 15.
capital gains, right? It's 15%.
I think maybe 15 or 20, but I think it's 15. But it's after like a certain amount.
Hmm.
But let's just assume you
Put
get
that
only
there.
10 million after capital gains, right? At 7%, which is qualified dividends, you can get 7% with qualified. There's unqualified, which means you pay income tax. But with qualified, you pay capital gains. 10 million, 7%, that's $700,000 a year without touching the principal.
Well,
Not touching
that's
that 10
well
million.
that's if you're talking about individual stocks, right? I mean,
Yeah, but that's like
yeah,
safe stocks like tobacco. They're not going anywhere. Let's be
yeah.
honest. They pay like 7%, and
Well,
that's qualified too. Dividends.
and for what Harley is talking about, as far if you want to be a dividend investor, this ticker symbol right here is a good place to go if you want to passively invest in dividend stocks. This right here, Schwab High Dividend.
And by the way, real quick, I'll make something very clear as well. Like you probably would never have to pull these out because each one of those pays at least like 1%. So let's say assume the average, right? If you invest in all three, or even QQQ and VOO, the average what dividend maybe like what 1.5 maybe between the two.
For QQQ and VOO, it's like 1% or something like that.
Okay, let's
I mean,
assume 1%.
it's not
You know,
very
you know what
much.
1% of 84 million is 840,000. I mean, it's not much. You're getting 1%, but you're not touching your initial investment, and you're just $70,000 a month.
Yeah, if you can, if you leave that in there until you retire, then you just live off.
And
the
you just
dividends.
you can use the 84 million
Yeah.
as leverage for anything you want.
Basically, yeah.
Yeah.
Yeah, I mean, well, if you make that much money as well,
Exactly.
there's another YouTuber, Ben Mala, who we used to watch, the
Oh yeah,
real
he's
estate
funny.
guy, great guy. He's selling. He's older now, and he makes great videos. I recommend watching him. Shout out to him if you're want to figure out how to build wealth through real estate. But he's selling off his portfolio, and he's like, I don't know if he's close to a billionaire now, but he's selling off most of his portfolio. And he probably already did because that was in an older video from like a year ago, and he was buying municipal bonds, like selling off like a couple $100 million of his real estate portfolio, and he was just taking 5% municipal bonds, and that's something you can do later on.
Well, yeah, where his market is, I mean, real
And
estate
they're
got
tax
hurt
free.
pretty
Municipal
bad.
bonds are tax free, so
Yeah.
yeah. So if you get to that level, and 5% a year off of 500 million is like what? That's 50 million a year. Well, how much? No, I'm
No,
like
no, no.
like
Five.
25 million a
I think
year, right?
yeah.
25 million a year. Yeah, because 10% would be 50. So about 25 million a year just off of municipal bonds, right? But
And that's a lot.
if you're young and, a bond I really don't recommend when you're young because who wants to make like a measly few percent a year? I mean, the bonds when the interest rates were higher were paying out 5%. Now they're paying like what, 3.5%, and inflation is 2 point something percent.
Right
So
now,
you're
yeah.
really only making 1% a year on those bonds. So, but if you were talking long term, but for the layman's, for the regular guys like us, this is probably the best thing to do. And like Harley was saying, and you do want to do some dividends, there's SCHD. And then there's those other companies that Harley was talking about, which I don't really do too much. I mean, I don't even own SCHD
I
anymore.
would just, I'm only saying those for like once you're ready to like retire, you want income from it, right? Like you dividend income.
Mm.
I'd recommend switching to like stable companies like be Coca-Cola, tobacco companies, like companies are not going to go anywhere that pay like 2, 4, 7%, right? Because they're qualified. There's qualified and unqualified dividends, right? And non-qualified. Now, if you're getting so much money, it doesn't freaking matter to you. Like, so you can get paid 10%, right? 10% over off 87 million is 8.7 million. That's pretty good. I mean, I don't think pay what income tax is still what 37%
Yeah.
after, let's say 30. You're making $5.48 million, right? But
Based off of what initial amount?
no, I'm talking about the one on the right. So if you do that one,
Oh.
Do 2,000 a month.
yeah,
Yeah.
and you got to the 87K or 87 million at the end.
87 million,
Yeah, yeah, yeah. I made the same mistake.
40
Yeah.
years is a long time. Though.
Well, you can retire earlier, take income
That's
from it
most
earlier,
people
right?
probably end up
Yeah,
retiring.
after 30 years, you got 18 million.
Let's say you just do 18 million, right? And let's say minus the 15%, whatever, 15.3 million after, right?
Oh, by the way, we changed the values to this guy's for 2,000
Mhm.
per month. So, in case you're wondering,
So you have 7% of that, so you do qualified only. That's 1,071,000, right?
Right.
And now let's
Yeah.
say you decided to do more non-qualified, which you still got to pay income tax, so you get 12%. That's 1.8 million, but
yeah, but where are you gonna get 12% on dividends? I wouldn't trust those.
no, you
companies.
can, but those are non-qualified. So like BlackRock, Chase, like they have what's called like income supplements for retirees,
Mm.
but they don't pay income before those dividends. So that's what they're called non-qualified. So you have to pay income on them. That's why they count as income instead of capital gains.
Okay.
So there's qualified and non-qualified.
So the okay, gotcha.
But like Altria, like pays 7%, but it's also qualified.
Mm.
So that's a lot for a qualified dividend.
Altria, yeah. I
Yeah.
used to own Altria. But yeah.
And it goes up like pretty decent. I think it goes up like 50% every like 5 years. But hey, it pays also 7% a year as well.
How can we pull up like I want to go to Yahoo Finance.
So
So yeah.
you
Can we just search or no?
no, so you want to switch to OBS
Here, I'll
screen
let
as well.
you. Yeah. So we can start talking individual stocks. But
Okay.
that's my quick little rundown, guys, on just VOO and QQQ.
Mhm.
I recommend this personally. For you, it's up to you to decide. But that's a winning portfolio for sure. Just those two.